Good morning, friends. Sunday's class, we started the chapter Dividend Policy, in which we completed the discussion about Walter's approach, Gordon's approach. We had an elaborate introduction to Modigliani-Miller approach. We have to do one problem in the Modigliani-Miller approach in the workbook, that is question number 9. We will complete it first. Once we complete question number 9, I will do one more extra problem in the Modigliani-Miller approach to get a grip over or revise once again the concepts. Then I said I have to make some discussions regarding the share valuation, which I will do with the help of the example which I have given in the yesterday's class or in the previous class. Then we will do two more sums left out in between, that is question number 2 and question number 3 in Walter and Gordon, and try to complete at least one sum today in the rights issue concept. We have two rights issue problem. Both are institute problems only. One is a past exam question, another is an RTP question. Both questions deals rights issue in different ways. We will deal with the rights issue at least one problem in today's class. Next class we will complete one more problem in rights issue and buyback of shares. In the subsequent class, one or two problem left out here and there in Linter's residual model and all be completed. I will start with another very important and big chapter called as portfolio management or portfolio theories, which will go for another 7 or 8 classes. We will be discussing that particular chapter, portfolio theories. Please settle down. And that class timing is at 6:15, right? So, first class everybody was on time. Slowly you are getting late. It creates disturbance. Please try to be here by 6 o'clock so that we can be sharp here on 6:15. We can start the class at 6:15 exactly. Okay, those who come late without creating noise, settle silently. Can we start or not? Now, let us summarize the discussion made till now in the dividend policy before we continue with the problem. Stop talking. See, company raise finance, invested in the asset which generates return, which will be used to service the finance provider. This is the normal business cycle. In such case, when the return is generated, it should be used to service the fund providers or finance providers. How much of the return should be given to the debt need not be decided, because it is already predefined or predetermined in the indenture itself. So regarding equity only, should we give dividend or not is the issue. This policy we call it as dividend policy. There are 3 decisions: financing, investment and then dividend decisions. Financing decision affects the wealth through the cost of capital. Investing decision affects the wealth through the IRR of the returns. And will the dividend decision affect the wealth of the company or shareholders is an issue that is being discussed. Yes, it will affect the wealth. Those who say yes, dividend policy affects the wealth are called as theory of relevance. Do not affect the wealth are called as theory of irrelevance. There are 2 theories of relevance, Walter approach and Gordon approach, and a theory of irrelevance called as Modigliani-Miller approach. What Walter says is that when a company earns profit, it can do 2 things with that: either declare it as dividend or retain it. If we declare it as dividend, the investor can invest it elsewhere and earn a return, which we call it as KE. I just use loosely this particular definition. KE is much more bigger. We will discuss in the next class, that is next chapter. But understand that you can invest the money elsewhere and earn some return or not, that at least the company should earn for him, which we call as KE. The return the investor expects from the money that is given to the company is called as KE, cost of equity. On the other hand, if the company retains the money, it has to invest the money in the project's pipeline, and it earns a return. Such a return is called as IRR or R. If the return on the proposed investment is more than the KE, the expectation of the shareholders, then you can retain the money. If your proposed projects cannot satisfy their required return, if R is less than KE, then give their money back, they can manage it on their own. If it is equal, then we may be indifferent. So as per Walter, R greater than KE, retain fully, R less than KE, distribute fully, R is equal to KE, any retention is okay. He values the share using the formula P0 is equal to D plus R by KE into E minus D whole divided by KE. Next, Gordon says, yes, Walter is right, relevance only, dividend affects the share valuation. But we cannot take an extreme view that 100% payout or 0% payout is always the optimum payout. It is not so, because it brings a risk angle to the retention. When you retain, the advantage is growth. Now retention gives you new investment. New investment gives you growth. And advantage of retention is growth. But a promised future capital gain is riskier than a current income. A bird in a hand better than two in the bush. In such a case, they said retention is also creating a risk in the minds of the shareholders, which will increase the KE. So advantage of retention is growth and disadvantage is risk. It is opposite for dividend. Advantage of declaring a current dividend is the shareholders feels the company to be less risky. At the same time, growth will be stagnated. And Gordon gives a formula for share valuation. P0 is equal to E into 1 minus B divided by KE minus BR, where E is the EPS, B is the retention ratio, 1 minus B is the payout ratio, E into 1 minus B is dividend, divided by KE is the discount rate, the required rate of return of the valuer, and B into R is growth rate. Growth depends on how much you retain and what you earn on the retention. So G is equal to BR. This is the Gordon's approach. He says, whichever payout, whichever B gives you the highest share price, that should be the optimum payout as per the Gordon's model. This formula is nothing but our dividend growth model formula only represented. We discussed now D1 divided by KE minus G. That formula also is nothing great. It is the present value of an infinite dividend. Infinite level dividend or growing dividend? Growing dividend. So that is a present value of a growing perpetuity only. We called as dP0 is equal to D1 by KE minus D, whose derivation also incidentally we saw 2 classes ago. Everybody following or not? Now, once we completed that, then we discuss about the next concept called as what? Modigliani-Miller approach. What MM says is that whether you declare dividend or do not declare dividend, it will not affect the wealth of the company as well as the shareholder. He did not say it will not affect the share price. He only said it is not going to affect the wealth of the company or the shareholder. We understood that with the help of a small example. A company had equity of $10,000, which is represented by a cash asset of $1,000 and fixed assets of $9,000. It is now having 1,000 shares. It wants to make a new investment for which the money required is $1,000. We saw there are 2 options for the company. One is use this $1,000 cash to the new investment, plow back into the business. Such a case, nothing happens. That $1,000 cash becomes what? Fixed assets. The balance sheet becomes fixed assets what? $10,000. That's all. Nothing is going to substantially change. Other option is to declare the $1,000 as dividend. When I declare the $1,000 as dividend, will my investment stop? No. MM says that if an investment is good, we'll continue with that investment whether or not we have the dividend or no dividend. So if I declare this $1,000 as dividend, where to go for money for investment? I'll raise the money through new issue. I raise the money through new public issue of shares. Due to this, what happens is $1,000 goes out as what? Dividend. It becomes a $9,000 company. Shared by how many shares? 1,000 shares. Every share becomes $9 per share, ex dividend price. At the $9 per share, I'll be issuing new shares for how many dollars? $1,000. How many new shares are going to be issued? 111 new shares. How many dollars comes back? $1,000. Look at the company. Company distributes $10,000 as dividend. It gets back the $10,000 as what? Capital. And it gets back the $1,000 as capital. Will the company $10,000 wealth remain same or changes the same? Only difference is earlier this $10,000 wealth was shared by 1,000 shares. Now it is going to be shared by 1,111 shares. Same wealth, when I declare dividend and raise new money, the money is going to be intact only. The same money will be there with the company, but the problem is more number of shares, which is going to dilute the share price. So the shareholder getting dividend has an advantage as well as what? Disadvantage. Advantage is he get the cash of $1 as dividend. The disadvantage is $10 share becomes what? $9. So $1 dividend and $9 share will be still what? $10 only his wealth. So his wealth remains unchanged. Is what we have proved both for company as well as the shareholder. Above this we wrote the notes. Finished or not? In the last class we also completed this discussion. If I am right, Modigliani and Miller also had a share price formula. Do you all remember the formula for share price? Tell me the formula. NP0 is equal to P1 into N plus M minus I divided by plus E divided by 1 plus AE. Then in between I have one more formula, MP1. MP1 is equal to I minus E minus ND1. And we also derived these two formulas and understood it. Response is or no. With this background, we can complete a problem. Only one type of sum is there in entire Modigliani Miller. That is again asked so many times in examination with only the numbers being changed. We'll be doing one sum from the workbook and one more sum I'll dictate and do it just for the sake of grip or practice. And then we can go back and have some more discussion. Those discussions are very essential for to really understand how shares are valued, what is the net present value of every project, every issue will be discussing, coming back and discussion. Okay, the discussion is not problem related, they are all concept based. We'll come to that discussion once you are thorough with solving a Modigliani Miller approach problem, because always problem solving also is important. We should be thorough with that and then come back and go for elaborate discussion in the next stage. Everybody up to this, are you comfortable or not? Okay. Now, before that, bond evaluation chapter I have completed, right? Whatever done in the classroom first, have you all started revising? Bond immunization, forward rates, convexity, realized yield to maturity, duration, volatility, convertible bond. So many have been discussed or not? Now, please. Never undermine revision, because what you learn in class can be consolidated, can be reaffirmed only through the revision. It may be lazy to look at the same thing again, because now only learn. Why should I say have a relook at it once again? Not so, because always we want to learn new things, but we don't like to revise what old things. The mind may be lazy, but if you revise, you reaffirm, it will be giving a much more clarity and grip. Okay. If somebody asks you about bond evaluation, you should be able to teach it. Such a way one should be revising it. Every notes which you have dictated should be properly revised. And here again I say, don't accumulate. Let me revise in the last 1 month, or those are attending for 2015, 2016 or even 2025 batch. Okay, Abdul Kalam said plan 20 years from now, yes or no? All those persons also don't think exam is far away, let me revise later. Then if you look like that, you will revise later by attending the batch once again. Because you will be forgetting everything. I am not cursing you. Then and there, please. It is very good. I am not joking here. Joining very early for exams that is happening far say away is very good, because you have a lot of time to prepare, revise and even go for further reading, because What we do here is not finality, because subject is vast, everything is what? Ocean. You can just go for further reading. More RTBs can be solved, more books can be purchased and what? Read. I don't deny that. But first of all, your advantage of joining early is not to prepare slowly. Understood? It is to prepare with what? Same speed. How those are writing the current exam revises. Suppose they are revising the same way, those writing the exam far away also should be revising immediately. I am just saying again out of caution, whatever I discuss now, it will immediately, very fast fade away in memory. Learning is very difficult. Forgetting is very easy. Because learning now, we have to put lot of effort to understand it. Once you don't consolidate, reaffirm, it will be lost. We saw no, bond may give 11% YTM, but you should earn also what? Same 11%. Only when you are able to reinvest back at the same YTM. Yes or no? The reinvestment only we call here as what? Revision. I am taking this 1 or 2 minutes time just to tell you, because 2 chapters over. Money market heads, remember? Yes, really? Yeah? Nambalama? Okay, so like that, then I should ask the same question after 1 month. Okay, I also wish you remember, not that I want to prove myself that you should forget it. If you remember, very happy. If you don't remember, no need to feel unhappy. Once again, go on what? Revise. All are not rocket science. Yeah. Everything is very simple only. Once you revise, you will be able to get the grip immediately. Okay, now take question number 9 in Modigliani-Miller approach. When we do the sum, don't think too much logically. Whatever prima facie understanding, with the help of that, the problem can be very easily and quite easily solved. Aim is to understand whether the problem is able to be solved or not. Okay, I'll have an in-depth discussion about MM after the problems are over. Okay, now take question number 9. ABC has a capital of rupees 10 lakhs in equity shares of 100 each. Tell me how many shares are there in this company? 10 lakhs divided by 100. How many shares? 10,000 shares. The shares currently quoted at par in the stock market, in the stock exchange. It is now trading at how much rupees? 100 rupees. Share need not be trading at par, can even trade at what? Higher price or lower price, but is currently trading at 100 rupees. The company proposed declaration of a dividend of 10 per share at the end of the current financial year. This dividend is D0 or D1? D1. Proposed dividend now. The capitalization rate for the risk class to which the company belongs to is 12%. What is this 12%? KE. The word capitalization rate means at what rate you require to capitalize the earnings. What will be the market price of the share at the end of the year if dividend is not declared? B, if the dividend is declared. Assuming that the company pays dividend and has net profits. Okay, company pays dividend and has net profits of rupees 5 lakhs. And makes new investment of 10 lakhs during the period, how many new shares must be issued? Use MM model. Okay, go through the question before we start with the solution. Don't talk. This is the only type of problem in MM. They cannot ask any other question here. The question is always standardized. If you know to do this sum, then all sums in MM will look similar only, numbers only will change. Shall we start? Okay, see, Today, the company is having how many shares? 10,000 shares. The shares are trading in the stock market at what price? 100 rupees. Always when I say price, I don't mean the book value. I always mean in this subject, market value. Trading at how much rupees? 100 rupees. And at the end of the year, the company plans to declare how much dividend? 10 rupees. The proposed declaration is how much rupees? 10 rupees. And what is the KE given? Okay. Now, tell me, do we have P0? Huh? Yes, 100 rupees. The share is trading today at how much rupees? 100 rupees. So, the current market price, I call it as P0 here. The P0 is what? 100. We know KE or not? Yes. We know D1 or not? Yes. Then I have to find out P1. That's the question. The question is, what will be the market price of the share at the end of the year? What will be, I am not like an astrologer, I am only guessing. This should be the market price. The market price of the share at the end of the year, if the dividend is declared and if the dividend is not declared. I'll use this formula to find out the share price. Can we start or not? Now, let's start with the discussion. Now, first, why? When dividend is not declared. Okay, the dividend is not declared. Okay, now, what is the price today? 100 is equal to P1 I have to find out, plus dividend is what? Nil, divided by 1 plus KE is 1.12. Okay, now just I rearrange it, I get P1 is equal to 100 into 1.12 is equal to 112. Now, very simply, how to understand this is, today the share is selling at how much rupees? 100 rupees. I require how much return? 12% return. Now, no dividend. I want to keep the share for 1 year. It's a single holding period model now. I want to keep the share for 1 year. No dividend given. I have invested 100 rupees. I want a 12% return. The man should earn how much rupees? 12 rupees on that share. That 12 rupees should come only from capital gain. Yes or no? That means I believe that the share will trade after 1 year at how much price? That is why I am willing to pay 100 rupees today by discounting at 12%. Reverse way of understanding it. Are you following or not? No. The share price expected, and a year from now is how much? 112. You are the investor, you are expecting like this. You are expecting that the share will trade at how much rupees? 112 after 1 year. You also expect no dividend to be declared, and you are willing to, you are wanting how much return? 12%. Your future cash flow is how much? 112. The present value is what? 100. Is the price you are willing to pay for the share? Yes or no? It is not you are willing, this is what the market is expecting. This is what the market is expecting. So the share price, if no dividend is declared, if everything works as per plan, should be how much rupees? 112 rupees. After 1 year, respond, accept or not? Now, suppose, next question. When what? The dividend is declared. Okay, always people guess who is this here? Similar to Govindan sir, yeah? Yes or no? So when the dividend is declared, what is going to happen to the share price? Can you proceed? 100 is equal to, P0 is equal to, P1 I have to find out, plus what is dividend? 10 rupees divided by 1.12. Yes or no? That means 100 into 1.12 is equal to how much? P1 plus 10. And P1 is equal to how much rupees? 102. And dividend is equal to 10. That is, if 10 rupees dividend is expected to be declared, the share price cannot be 112 because it is come dividend. Yes or no? It should be only how much rupees here? 102. Because 10 rupees dividend goes out of the company. Respond yes or no? Now, another example is, you are buying a share today. Yes or no? You expect that the share will give you how much dividend? 10 rupees dividend. You want a 12% return. That means the share price should be trading at 102 after 1 year when the dividend is declared. Respond yes or no? Why without dividend the share is 112? Why with dividend the share is 102? Because without dividend the company is more wealthy because the money has not gone out of it. Yes or no? With dividend the wealth of the company reduces because some of this assets has been shedded, has been given to the shareholder. Everybody yes or no? So earlier it was a share price loaded with dividend. Now the share price is sans dividend. It is without what? Dividend. 10 rupees has gone out of the company, hence 112 can become what? 102 if the dividend is declared. Everybody, yes or no? Now, all this I link you to the first example later. Independently understand the question. This is how the MM problem has to be solved. Can I proceed further? Now, tell me, when dividend is declared, what is going to be the share price after 1 year? 102. When dividend is not declared, what will be the share price? 112. Up to this, are you following or not? Now, let's go to the third part of the question. See. Number of shares to be issued. There was a question, how many shares to be issued? Why should I go for new issue? Because end of the year, I am going to start a new project. Why should I go for the new issue? Because I am going to start a new project at the end of the year. Right or not? Now, let us see what is going to happen. Tell me, how much money is required for the new project? Everybody. How much is here? 10 lakhs. So, when dividend is not declared, first situation, I require how much here? 10 lakhs. 10 lakhs, entire 10 lakhs, should I raise through new issue? No. In which already I will be financing through what? Retained earnings. How much of base? 5 lakhs. The current year profit of 5 lakhs retained earnings can finance my investment. Out of the 10 lakhs, finance 5 lakhs through what? Net profit or retained earnings. What should be the new issue amount? The balance 5 lakhs. Yes or no? This 5 lakhs I should issue to new shareholders. Right or not? I'll issue at what price here? When dividend is not declared, I can issue how much price? 112 rupees. Ennappa, right or not? So what happens is, issue price when no dividend is declared is 112. The number of shares to be issued is 5 lakhs divided by 112. That gives you 4,464 shares. Yes or no? All these are happening today. After 1 year, after 1 year. Respond, yes or no? After 1 year, I want to make a new investment for how much lakhs? 10 lakhs. In which the profit expected is 5 lakhs to be financing it partially. Balance 5 lakhs needs to be raised. And I am going to raise without declaring dividend. And the share price is expected to be 112. I expect to issue how many shares? 4,464 shares. And here hence to finance my new project. Accepted or not? Now. When dividend is declared, how much money required for new investment? 10 lakh. In which, how much the current year profit? 5 lakh. Can entire 5 lakhs be used for funding up? No. Out of the 5 lakh profit, I declare dividend or not? Every shareholder will get how much dividend? 10 rupees. How many shareholders are there? 10,000. How much goes out as dividend? 1 lakh. What is the balance money left for funding? How much going to be? 4 lakhs. Out of 10 lakhs, 4 lakhs gone for investment. And how much should be the fresh issue? So I should raise through the new issue. How much should be? 6 lakhs. This 6 lakhs should be issued at a price of 112 or 102. Now once the dividend is declared, it becomes a ex-dividend price where the price becomes 102. 6 lakhs divided by 102 is going to give me how many shares? 5,882 shares. Earlier issue 4,464 shares, now 5,882 shares. Because without dividend, few number of shares enough. With dividend, more number of shares comes and the price gets diluted. Everybody yes or no? Now, it is a simple way of understanding it. We can even find out number of shares using a formula. Tell me the formula. MP1 is equal to I minus E minus ND1. Now, in which M is number of shares to be issued. P1 is the price at the end of the year. And I means what? Investment. E means earnings. N means current number of shares. And D1 is dividend. Right or not? Now, we can do the same thing. Exam also present using formula. Alternatively, MP1 is equal to what? I minus E minus ND1. Right or not? Please substitute the number. M into P1 when dividend is not declared. M into what is P1? 112. M into 112 is equal to what is investment? 10 lakhs minus earnings is what? 5 lakhs. Why minus 0? No dividend. If I rearrange, I get M is equal to 5 lakhs divided by 112 gives you 4,464 shares. Accepted? Now, tell me, for this you tell the calculation here. What into what? M into 102 is equal to 10 lakhs minus 5 lakhs minus 10 into 1 lakh into 10. If I just rearrange, I'll get the number of shares as 5,882 shares. Is the formula of finding out the new number of shares to be issued. Always in examination, Modigliani Miller problem, they ask how many new shares to be issued as per MM. This is how it should be answered. Everybody, are you following or not? So now, The question has been answered here. What are 3 questions? Look at the workbook and tell me what are the first 2 question. First question, what will be the market price of the share at the end of the year if the dividend is not declared? What answer? 112. When the dividend is declared? Next is, assuming the company etc. they given, how many new shares must be issued? How many shares should be issued? 4,464 if the dividend is not declared. And next is what? 5,882 when the dividend is declared. It is a standard 8 marks question regularly in the examination. Last RTP also a same type of sum has been given. No more extra sum in this particular concept. Everybody following or not? Now with this we complete the solution to this problem, but still I'll proceed and prove the irrelevance and then leave you. Okay, now see, wealth of the shareholder. Wealth is a burden, right or not? So wealth of the shareholder. Okay. Price 112. Suppose no dividend declared. What is the wealth at the end of the year? Having a price of 112. What is the dividend? Nil. What is the total value of his portfolio? 112. His wealth is 112 year hence. Present value of the wealth is obviously what? Current market price of 100 rupees. Right or not? Now, suppose the dividend is declared. What happens to the price of the share? 102. So his wealth is 102 or? No. His share, that is, if he prepare his balance sheet, investment, it becomes what? 102. Another thing, bank account will be there or not? In that, there will be a cash of how much rupees here? 10 rupees. By way of what? Dividend. So, if you add the balance sheet total, it will change the same only. Instead of having an entire wealth as investment, they are going to split into what? 2. One is a bank balance of 10 rupees and the investment worth of how much? 102. The wealth is still how much? 112. So, whether I declare dividend or don't declare dividend, the wealth of the investor remains same, 112 rupees is proved here. Response is or no? Now, value of the company. This is the value of the company. Tell me what is the value of the company today? Number of shares into price of the share. Yes or no? We have the formula. Tell me what is the formula? P1 into M plus N minus I plus E whole divided by 1 plus KE. No dividend declared means what is the price of the share a year hence? 112. Into how many shares are there? 14,464. How it is? Already old share 10,000. The new shares 4,464. This is the total number of shares. 112 into 14,464. Minus what is investment? 10 lakh. Plus what is earning? 5 lakh. If I divide by 112, this number, I'll be getting 10 lakh rupees. How much rupees here? 10 lakh rupees. It proves that 10,000 share what? 100 will be the wealth of the company, 10 lakhs. If the dividend is declared, this 102 into 15,882. Every other number is same here. Instead of this 112, the price becomes what? 102. But instead of 14,465, it becomes what? 15,882. The share and share price will change, but the wealth remains what? Same only. It still continues to be 10 lakh rupees. Everybody, are you following or not? So this is regarding the Modigliani-Miller approach problem. Response, yes or no? Tell me. With dividend, without dividend, is the company wealth changing or not changing? Not changing. With dividend, without dividend, is the shareholder wealth changing or not changing? Not changing. Is the dividend relevant for wealth? Not at all. Is on Modigliani-Miller proves. There are a lot of very interesting issues which are hidden inside this discussion. I'll discuss all those once you finish copying the solution, because I don't want you to get too much confused. I want you to do a problem very clearly. Okay, that's how you have to do the Modigliani-Miller problem. Before that, don't think very primitive, otherwise let us by heart it. Okay, first of all, problem is asked. Problem is asked. First step is to find out P1. Always, I'll say, in every problem, first step is to find out what? P1. Which formula will be used to find out P1? P0 is equal to D1 plus P1 divided by 1 plus KE. That will be used to find out the P1. That P1 will be found out without dividend, with dividend. Without dividend, P1 will be higher. With dividend will be what? Lower. By how much amount? Dividend amount. Response is or no? Once you find out P1, the question always asks you to find out the number of new shares to be issued. You can either do logically or simply using what? Formula. What the formula for number of new shares to be issued? MP1 is equal to I minus E minus ND1. Once you know that, we can prove the irrelevance of the shareholders as well as what investors will to the dividend. Shareholder can either own investment alone or investment with what? Cash, by way of dividend. If no dividend, investment value is higher. Dividend means what? Investment value drops, but cash comes in for him in the balance sheet. Yes or no? For a company, it is going to be irrelevant because wealth is going to remain unchanged. Earlier, 14,464 shares are going to share the wealth without dividend. It will become 15,882. The fall in share price will be taken care of by more number of shareholders. That's all. Company wealth, individual wealth remains unchanged. Is a proof of approach. Everybody, are you following the pattern or not? And this consolidating because when I go for some extra discussion, you may be lost in the discussion. So I want you to make thorough regarding the problem solving and then go for further discussion. Everybody have the clarity here? Now, copy the solution quickly. We'll do one more problem that you should do and tell me the calculations. I don't have the type. We'll be doing it together. And then we can just go for some very important, interesting discussions. Okay. Now, question number 9. Question number 9. Okay. Write down. P0 is equal to. You may all ask the question, sir, in this we assume I am going to hold the share only for 1 year. When you hold for 2 years, will the value change? No, we'll prove it. Now we may not be able to understand it. We'll prove that in the equity valuation chapter later that holding period will never affect the value of not only share, any asset as a case may be in the world. Okay, that you can forget it. It is a single holding period I use to prove the entire theory. Okay, P0 is equal to P1 plus D1 divided by 1 plus KE. Can I move to the next stage? Now, first, part 1. Right, part 1. Year-end share price when dividend is not declared. Year-end share price when dividend is not declared. Only copy the sentence, not the picture. Okay. Year-end share price when dividend is not declared. P0 is equal to year-end share price when dividend is not declared. P0 is equal to P1 plus 0 divided by 1.12. And no dividend expected na, P0 is equal to P1 plus 0 divided by 1.12. 100 is equal to P1 plus 0 divided by 1.12. 100 is equal to P1 plus 0 divided by 1.12. 100 is the face value of the share. True or false? 100 is the face value of the share. True or false? No. I am writing here what? Market price. Don't think I am writing face value here. Had the market price been 90, I would have done only what? 90. Now investor never invest face value. He invest only what? Market price to buy the share. Yes or no? So it is P1 is equal to 100 into 1.12. P1 is equal to 100 into 1.12 is equal to 112. P1 is equal to 112. Part 2. Year-end share price when dividend is declared. Part 2. Year-end share price when dividend is declared. Year-end share price when dividend is declared. Shall I proceed? Now. 100 is equal to P1 plus 10 divided by 1.12. 100 is equal to P1 plus 10 divided by 1.12. 100 into 1.12 is equal to P1 plus 10. 100 into 1.12 is equal to P1 plus 10. 112 is equal to P1 plus 10. P1 is equal to 102. Price at the end of the first year is expected to be 102. P1 is equal to 102. Can I proceed or not? Next. Part 3. Part 3. Number of shares to be issued. Part 3. Number of shares to be issued. Now there is 3 questions. There are 3 questions in this problem. Part 1, part 2 answer. Part 3. Number of shares to be issued. Part 3, number of shares to be issued. Underline that. In that write A. When dividend is not declared. Number of shares to be issued, underline that, in that capital A, when dividend is not declared. When dividend is not declared. Requirement for new investment. I ask a question, will this new investment stop because I declared dividend or did not declare dividend? No. Whether I declare or not, I am going to anyhow do the new investment. If I declare dividend, more money should be raised from public. If not, more can be financed through retention. That's the only change. I think you are following now? Now, when dividend is not declared. Requirement for new investment, 10 lakhs. Requirement for new investment, 10 lakhs. Branch it into 2. Net profit 5 lakhs. Net profit 5 lakhs. Amounts raised by share issue 5 lakhs. Net profit 5 lakhs. Amount raised by share issue 5 lakhs. Amount raised by share issue 5 lakhs. I hope you are following up now. Continue. Issue price, bracket, no dividend declared, 112. Now that share is worth 112 because it is having that surplus cash also in its hand or not. So issue price when no dividend declared, 112. Issue price when no dividend is declared, 112. Number of shares is equal to 5 lakhs by 112. Number of shares is equal to 5 lakhs by 112. 4,464 shares. Number of shares is equal to 4,464 shares. Can I proceed? Capital B. When dividend is declared, underline that. Capital B, when dividend is declared. Requirement 10 lakhs. When dividend is declared, requirement 10 lakhs. Net profit first branch 5 lakhs. Can entire 5 lakhs be used up? No. What happened to 5 lakhs? Branch it into 2. Dividend 10,000 shares into 10, 1 lakh. Dividend 10,000 shares into 10, 1 lakh. Available for investment 4 lakhs. Available for investment 4 lakhs. Out of 10 lakhs, retention financing is 4 lakhs. What is new issue financing? 6 lakhs. Balance to be raised through new issue. Balance to be raised through new issue. How much lakhs? 6 lakhs. Balance to be raised through new issue 6 lakhs. Balance to be raised through new issue 6 lakhs. Shall I proceed? Now. Now doing along with me or not? Is the speed okay? I have to be slower, a little bit faster. Okay. யாருமே ஒரு unanimity கிடையாது நாட்டில். Can I proceed now? Okay. 6 lakhs. Can I proceed? Now you should have not caught up with me. Can I proceed? Now. Next. Issue price. Continue. Issue price. No dividend. So issue price. Dividend. Issue price, dividend declared, 102. Issue price, dividend declared, 102. Number of ES here means what? Equity shares. Number of equity shares is equal to, number of equity shares is equal to 6 lakhs divided by 102. Number of equity shares is equal to 6 lakhs divided by 102. How many shares? 5,882 shares. 6 lakhs divided by 102, 5,882 shares. Can I proceed above? No. Alternatively, anyway you can present in the examination. Alternatively, we can find out the number of shares M through this particular formula. Copy this quickly. Finish copying, huh? Those who are not copy, raise your hand. Please fast. Stop talking. Finish copying or not? No. Write down. The problem is over. They asked 3 questions now. Share price year end, no dividend, with dividend, and number of shares to be issued. Problem is over. Okay, write down. Irrelevance of dividend. Continue. Irrelevance of dividend in shareholders' wealth. Irrelevance of dividend in shareholders' wealth and company's wealth. Irrelevance of dividend in shareholders' wealth and company's wealth can be proved as follows. Irrelevance of dividend, make a small change here, irrelevance of dividend for shareholders' wealth and company's wealth. Make it as for irrelevance of dividend for shareholders' wealth and company's wealth can be proved as follows. Can be proved as follows. Everybody, can I proceed or not? Now, right? Capital A. Capital A, wealth of the shareholder. Capital A, wealth of the shareholder. Branch it into 2. Capital A, wealth of the shareholder, branch it into 2. First branch, no dividend. Second branch, dividend. No dividend. Second branch is dividend. No dividend. Please put a down mark and write. Share price. He is having investment na. He is holding investment. What is the price of the investment? 112. No dividend. Put down mark and write. Share price 112. Dividend received. What is dividend received? 0. Dividend received 0. Portfolio value. Portfolio value. What is the value of the portfolio? 112. I think already said. What is the meaning of a portfolio? Group of assets. If you hold more than one asset, they call it as what? Portfolio. I am talking here about 2 assets. One is a share, another is a bank account. Yes or no? Correct? Now, in this case, I have investment. I have an investment. My bank balance is what? 0. That is, I only believe in dividend. That means the balance is what? 0. So the portfolio value is 112. Second branch, when dividend is declared. Second branch, when dividend is declared. Second branch, when dividend is declared. Don't make it right. Share price. What is the price of the share? 102. Since the company declared dividend, the price crashed to 102 because of its ex-dividend status. Okay. But does he have any apprehension? No. They received what? Cash. What the cash? 10 rupees. Dividend is 10. So he is having an investment worth 102 and a bank balance of 10. Again, his wealth is going to be the same, 112. The wealth is going to be the same, 112. Thus, wealth of the shareholder remains unchanged. Thus, wealth of the shareholder remains unchanged, with or without dividend. Wealth of the shareholder remains unchanged, with or without dividend. Wealth of the shareholder remains unchanged, with or without dividend. Can I proceed? Capital B. What is capital B? Wealth of the company. Capital B is wealth of the company. He uses, what is the wealth of the company? Number of shares into P0. Is the wealth of the company or not? No. Please, value of the company, copy this particular slide. Have you finished copying? Those who are not copy, raise your hand. Please fast. Please. Shh. Those not copy, raise your hand. Okay. Now, with this, we have completed the area Modigliani-Miller approach. Two more things are remaining. I want to do one more problem of the same type. That's the only type that is available. We'll be doing one more problem of the same type. And I have to also make some discussions. Okay. Let us do one more problem for us to get what? A grip over the calculation part, and then go for some very interesting and important discussions. Okay. Now, that problem I don't have in the workbook. Let us note down the question quickly and then do the answer together. You know. Problem, write the problem. X Limited has X Limited has 8 lakhs shares at the beginning of the year. X Limited has 8 lakh shares at the beginning of the year. Current market price is rupees 120. Current market price is rupees 120. The expected dividend for the current year is rupees 6.4. The expected dividend for the current year is rupees 6.4. And the rate of capitalization 9.6%. And the rate of capitalization 9.6%. Okay. Before I proceed to the next part, tell me what is 8 lakh shares? N. It is the current number of shares? N. What is 120? P0. The price of the share today. What is 6.4? D1. The dividend expected at the end of the year. What is 9.6%? KE. All this have been given. Can you guess what will be the question? Find the share price and year later if dividend is declared and will not. Question A by heart. Right or not? Now, next. Required. Based on MM calculate. Based on MM calculate the market price. Based on MM calculate the market price. Calculate the market price if dividend is declared. Calculate the market price if dividend is declared and if not declared. If dividend is declared and if not declared. This is first question. Next question. How many shares are to be issued? How many shares are to be issued? If the investment budget is, how many shares are to be issued if the investment budget is 3.2 crores? If the investment budget is 3.2 crores and net income by the end of the year is rupees 1.6 crores and the net income by the end of the year is rupees 1.6 crores. Is rupees 1.6 crores. Number question. Can we start or not? Now. We are going to do the solution together. I don't even have the calculator. I don't have the slide. I am fully dependent on you. You should tell the correct calculation. in the way hearable to me. Can I proceed? Let's start with the solution. Can you start or not? First. Write down. Step 1. Step 1. Tell me the question number. Okay, it is example. Okay, leave it. Problem. Okay. Okay. Good morning. Can I proceed? Step 1. Step 1. Calculation of P1. Step 1. Calculation of P1. Calculation of P1. Can I proceed or not? In that A. No dividend declared. Calculation of P1. No dividend declared. No dividend declared. Can I start or not? Tell me the formula. P0 is equal to P1 plus D1 divided by 1 plus KE. P1 plus D1 divided by 1 plus KE. We know today the share price 120 rupees. 120 is equal to P1. D is what? 0 divided by 1 point. What is the discount rate given? What is the discount rate given here? 9 points. Outright it 0.096. 120 is equal to P1 plus 0 by 1.096. Can I rearrange and tell me P1 is equal to 120 into 1.096. Is it how much it is? 130? 131.52 is the share price expected in the year end if the dividend is not declared. To put it simply, if I buy the share today at 100 and the share price becomes what? 131.52, I am said to be earning a return of how much percent? 9.6 as a IRR from the share. Respond yes or no? Now, next, capital B. What is capital B? Dividend is declared. Dividend is declared. What is P0? 120 is equal to P1 plus, if I am right, dividend is 6.4 rupees. 6.4 divided by 1.096. 120 into 1.096 is equal to P1 into 6.4. 120 into 1.096 is equal to P1 plus 6.4. Rearrange, I get P1 is equal to 131.52 minus 6.4. What is the price here? 125 point. So the share price with dividend is 125.12. 125.12. Can we proceed to the next stage or not? Now. Step 3, they are asking you to find out number of shares to be issued. Can I proceed now? Next. Step 3. Okay, A and B now. Step 2. Number of shares to be issued. Number of shares to be issued. Can we start or not? Now, write the formula and then substitute. What is the formula? MP1 is equal to I minus E minus ND1. MP1 is equal to I minus E minus ND1. Capital A, no dividend. Capital A is no dividend. M into what is price when no dividend is declared? 131.52. M into 131.52 is equal to, look at the notebook and tell me how much investment is required? 3.2 crores. It is 3 crores 20 lakhs. I minus E minus ND1. What is earnings here? 1.6 crore. That means what? 1 crore 60 lakhs. 1 crore 60 lakhs minus how many shares are there? 8 lakh shares into what is a dividend? 0. No dividend is declared, no, dividend is 0. So M into 131.52 is equal to 3 crore 20 lakhs minus 1 crore 60 lakhs. Say minus 8 lakhs into 0. If I simplify, I get M is equal to, can tell me a simplified number here? 1 crore 60 lakhs divided by 131.52. I want round it off and tell me, don't tell me in fractions the shares. Well, how many shares? 1 lakh 21,000. 1 lakh 21,655 shares. 121,655 shares has to be issued when I don't declare dividend. Can I proceed or not? Next, capital B, dividend declared. Capital B, dividend declared. Shall we start now? Tell me, M into what is P1 when dividend is declared? 125.12. M into 125.12 is equal to what is investment? 3 crores 20 lakhs minus what is earnings? Tell me. 1 crore 60 lakhs. 1 crore 60 lakhs minus what is N? 8 lakh shares. No, 8 lakh shares are N? Yes. Into what is dividend per share? 6.4. 8 lakh shares into 6.4. Now please simplify and tell me the M. All of you do and tell me. M is equal to how much here? 1 lakh 798 shares. 1,68,798 shares. 168,798 shares. This is a solution for that particular sum. It was an 8 marks problem in the examination. Tell me, easy or difficult? Like that, second previous one also, one question has been asked. Last RTP also, same type of question. Numbers may change, but the calculation are same. For this model, this is a one and only type of problem that can be asked in the Modigliani-Miller approach. Exam wise, everybody tell me, are you all comfortable about the Modigliani-Miller problem and solution or not? No. Not required, but you can just go home and do. Prove the irrelevance. Prove what? Irrelevance. Dividend affect the wealth of the shareholder or? No. Without dividend, he'll be holding a share worth 131.52. With dividend, he'll be having a share worth 125.12. But cash how much? 6.4. For the company also, nothing is going to change. Use a NP0 formula. He'll be getting the same wealth with as well as without dividend. Is what the MM approach is all about. Now, first confirmation. Walter Gordon MM approach. Whatever discussed till now, those understanding with clarity, raise your hand. Okay. That said, what about balance here? Understood or don't like to raise a hand? Okay, sleeping. Okay, now. Don't talk. Now, freeze your understanding now. Okay, with this you understood. What is required for this concept in examination has been understood. Now I am going to start with the discussion. This discussion, I hope, should not confuse you. Okay, I hope should not confuse you. But still I want you to get confused and then what? Getting clear, because what I am going to discuss now only will be making you really understand the subject regarding the share valuation. These problems are straightforward. If they ask a case study type of question, that is also given one question RTP will be discussing in the classroom itself. In all those areas, the concept should be properly interpreted. For that we should know really what is happening. That is why I am going to go for this discussions. Very, very important discussion. I will give you the notes also. At the end of the previous class, so many people asked doubts regarding what? approach. I asked them to wait till what? Today's class. We have only discussed superficially or surface has been discussed. Lot of things are lying underneath this particular discussion. Above that, let us go for the elaboration. I'll discuss point by point and then give you notes in this regard. More about share valuation will be learning again when I go for various issues. When I go for rights issue, I have a very good problem where NPV impact on share valuation will be understood much more better. We have an equity valuation chapter where free cash flow models, so many angles to understand share valuation. I already said valuing share is like understanding God, right or not? So we can keep on speaking about God forever, right or not? Because so many things are mystery about God, yes or no? When something is mystery, you can keep on unearthing what? Unknown facts. Right or not? That is what I am going to do in the share valuation. Now let me go back to the example which I gave. From there, I'll start my discussion again. Okay, see. Okay. Every discussion which I make is useful in one way or another in the problems to be solved later. Okay. First of all, let's take this particular balance sheet. Okay. $10,000 equity I given, right? I said the company is having 1,000 shares and the equity is $10,000. My question is, this equity is share capital, reserves and surplus, both. The equity written here is share capital, reserves and surplus, both. It is neither of all the three. This is not our balance sheet at all. Understand? This is not your accountant balance sheet where we write so many items, all useless items, no use because share capital, reserve, so many items are given or not. This is not my book value balance sheet. Forget that. This $10,000 is not share capital, is not reserves and surplus because share capital, reserves and surplus are all about past. Balance sheet is about future, past. I am not speaking about past. For me, value is future benefit. Now, for us, old balance sheet is only to see what has happened. Post-mortem report. Yes or no? For us, we are not going to have all those. For me, I always say value of share means what? Future. Because value of shares depends on what the definition here. It is the present value of the future benefits. Now, don't understand this $10,000 as share capital. Don't understand as what reserve surplus. It is not our balance sheet at all. I'll tell you what this $10,000 is later. I'll tell you what this $10,000 is later. I wanted to tell that this is not your accountant's capital or reserve surplus. It is something different I am saying. Everybody following or not? Now, come to the asset side. Come to what? Asset side. How many assets I am having? What are two assets here? Cash and then what? Fixed assets. Okay. Cash is the money in my bank account or in what? Marketable securities. Liquid cash. Only call as what? Cash. How many dollars? $1,000. What is fixed assets? What is this $9,000 fixed asset? I take my accounts book. Okay. All asset I'll be having by balance carried down. Yes or no? To balance brought down. We have not. I total all the assets. My fixed asset total is how much? $9,000. True or false? False. That is book value of asset. I am not saying the book value here. Are you following now? So everything you say, I am not saying that. What you are saying, you may ask the question or not. Now, I'll tell you what this balance sheet means, how to read it. I call this balance sheet as the market value balance sheet or the real balance sheet of the company. Are you following? I'll say how it is. Fixed assets. What is the value of an asset? Present value of the future benefit the asset gives. Yes or no? Very simple here. Company is having so many assets. Company having what? So many assets. Land, building, plant, machinery, etc. Okay. You all look at so many assets. I look at so many projects. Very simple here. We have, suppose MT is example, really not. MT is owning this room. Okay. MT is what? Owning this room. There are so many assets here or not? There's a podium, there's a projector, and there is what? Okay, AC is there. Room itself is what? Asset. So many assets are there or not? Accountant looks as asset here. I will say it is a Chennai project. It is called as what? A Chennai project where these assets are put into a specific use. Yes or no? The value of the room is not the price I paid to purchase a room. The value of the room is a future cash flow which I am expecting to what? Generate from the room discounted in today's value. Are you following or not? Yes or no? Now, I cannot value every asset independently. Understand that? I cannot value every asset what? Independently. I cannot say the value of this room separately without taking into account what? A synergy effect of the value of all the assets along with the room. Yes or no? So, I will not classify assets as land, building, plant, machinery, etc. Every asset will be reclassified into what? Projects of the company. Everybody, yes or no? The company is doing a business or not? The value of the cash flow generated by the business is the value of its fixed assets. Are you following? Everybody follow what I am saying? In that case, the fixed asset is nothing but these $9,000 assets are employed in different projects or not? Yes, those projects we can estimate cash flows or not? Yes. So the present value of those cash flows expected from the project. Don't say how sir I can estimate. If you want to know the value, you should estimate. No other option. Value is not for the past benefit. Yeah, really, value is only for what? Future benefit. You should not ask a question, how sir I can estimate? Somehow one should what? Estimate the value of all your projects. Are you following or not? And the estimate may put wrong or right. Question arises, no? For that only discounted is there, KE. Are you following? How certain is an estimate and so much will be what? The KE also. The discount rate discovery, we have a separate chapter called as what? Portfolio. Forget about that. Understand that we should estimate. We should what? Estimate a value of all the projects. Nothing but what? The present value of the future cash flows. All the projects of the company is going to give me discounted at what? KE or discount at some rate of return will give me what? The value of the asset today. That is a $9,000. This $9,000 is not the book value which we see in the balance sheet. Everybody, yes or no? In the issue, now tell me, what is the value of the fixed asset? Present value of all the future cash flows I expect to generate from that asset is the value of the fixed asset. Point number one, yes or no? What is the value of $1,000 cash? $1,000. Don't take a future benefit because 1 rupee I am having in the pocket today. What is the value of the 1 rupee? 1 rupee only. So now today the value is what? 1 rupee. The value of $1,000 cash is what? $1,000 because it is not an asset, is what? Hard cash. Right or not? So this is the value of a cash and then what? Value of the asset. So now the company is a $10,000 company. The company is what? $10,000. Company is having a wealth of what? $10,000. That is, when I buy this company, I expect to get a benefit over number of years whose present value is what? $10,000. Yes or no? I am not buying this company for the past benefit. Suppose I am going to go for an outright purchase. I am going to go for what? Outright purchase of all the shares of the company. I pay how many dollars? Why I pay $10,000? For the profit already given. For the benefit to be received, that is reflected by what? The value of the assets. Are you following what I am saying? So the value of the company is how many dollars here? $10,000. This is the market value of the company. Respond yes or no. This balance sheet I call as market value balance sheet. Now, this $10,000 company is shared by how many shareholders? 1,000 shareholders. That is why every share is worth how much here? $10,000 is going to share by how many shareholders? 1,000. Is what how much here? 10 rupees. That 10 rupees is not the book value of the share. That's how the market price of the share is arrived at. Everybody follow not? So every share is worth how many dollars? $10. Now tell me, this $10,000 is a reserves and surplus, share capital, market value. I am having 1,000 shares. Very simple. They say no, Infosys, TCS, so much market capitalization. Right or not? So the company is having a market, Reliance is having a market cap of 11,000 crores. They say the number or not. Go and count the asset. Yeah, it won't add up to 11,000 crores. WTV value, right or not? How they say? Very simple. How many shares are there in that company? Into what? The current market price of the share. If I multiply, I say the market cap or market capitalization of the company, right or not? It is the wealth of the company, right or not? In this case, what is the market capitalization of this company? 1,000 shares are trading at what price? 10 rupees. The cap is how much here? $10,000. Is the wealth of the company. Respond. Are you following or not? So this balance sheet we call as what balance sheet? Market value balance sheet. Understand that in the world, really, there's nothing called as liability. Entire world, only one item exists. There are only assets. There are no what? Liability. Because don't say the equity share is liability, it is also asset. Understood? Equity share is what? Asset. Okay. You are holding a share. You are holding what? Share. You are holding a liability, asset. You are holding what? Asset. Okay. This asset, what happens is, it is going to give a right in a portion of a business asset. It is an underlying asset. Share is what? Underlying asset. The share is only a piece of paper or a number in a demat account. It is not per se going to have what? Any value. Yeah? The value of the share is derived from the value of the business. If the business flourishes, the share value what? Increases. If the business does not flourish, the share value what? Decreases. It is an asset which derives the value from what? Another asset called as what? Projects. The project value only becomes what? Share value. There is nothing called as equity share separately. Are you following what I am saying? So, in the world there is nothing called as what? Equity share. It is nothing but the value of project is divided between what? Different stakeholders. Some stakeholders may call themselves of debt. Some call themselves what? Equity. It is nothing but an instrument. It is a way of sharing the income and also sharing what? Right in the asset. It is not a liability, because in the world there is nothing called as liability. It is only a connotation which we use for settling things. That's all. Are you following what I am saying? The share is also what? Asset only, because we saw in the first class that if I had balance sheets of everybody in the world, the liabilities cancel out against what? Each other, and what remains is only what? Asset. Yeah, correct. All human beings balance sheet, you add it, yeah? What happens? Only asset remains, no liability. If at all we are liable only to God, because everything is given by Him only, right or not? Right, yeah? Joke about land, we are saying I am owning this land, yeah, you created, right or not? So everything is what? Already there, yeah, everything is already there, only sharing its benefit. Are you following what I am saying? In that case, God is a non-entity, right or not? We cannot see, we cannot create an entity like that. Don't say Income Tax Act, okay, so that is different. In that case, everything is only what? Asset. How to share the benefit of asset only? We call as what? Liability. It is a derived asset. Liability is what? Derived asset, whose value comes only from what? Asset. So I should not pass any journal entries and all for liability. Liability is a balancing figure. The company is what? $10,000 company. Its share value is what? $10,000. The company becomes $8,000, means share value becomes what? $8,000. Don't say, sir, he given only $1. How it can become what? $0.8? Not at all. Yeah. It is only a derived asset. If the asset changes in value, the liability also what? Automatically change in value. Balance sheet only one side, called as what? Asset side. The asset side is divided by what? Number of shares to get the value per share. Everybody following not? This is the meaning of a market value balance sheet. Point number one. Everybody accepting it or not? Okay. Next point. I will go more into the angle of share valuation and the concept of NPV. Can I proceed, Appa? Now, see, I said that $1,000 cash can be distributed as dividend. Correct? Or the $1,000 cash can be what? Invested back into fixed assets. Right? Yes or no? Okay, let's go for the discussion. Very important. This adjustment will be there in one of the rights issue problem later. See, $1,000 cash is there. I am going to invest that cash in a new project. I am going to invest that cash in a new project. I am going to buy a fixed asset. I am going to buy what? Fixed asset. The cash become fixed assets or not? In accounts, what the entry you pass? Tell me. Fixed assets to what? Cash. How many dollars? $1,000. The account and balance sheet is very simple. The cash vanishes. It becomes what? Fixed asset. $1,000 cash vanishes. It becomes what? $1,000 fixed assets. This is the entry and accountant passes, and the wealth remains what? Same. Yes or no? No. That is not what I am doing here. Okay. Now, in this case, I said $1,000 cash became what? $1,000 fixed asset. I don't say the fixed asset value is $1,000 because I invested $1,000. I say it is $1,000 because here I assume that the present value of the future cash flow is what? $1,000. Are you following? Once the cash becomes fixed asset, cash may have $1,000 one value today, but the fixed assets need not have what? $1,000. It is the present value of what? The future cash flow I am expecting from this project. Yes or no? When the Mardigilani Miller say, I have an investment opportunity of $1,000 now, I assume that the investment also is $1,000. The present value of what? Future benefit also is what? $1,000. The NPV 0 I assume here. Are you following or not? I assume NPV to be what? 0. I'll give you 2 more situations and make your understanding much more better. Are you following or not? Now, understand that, first of all, when I start a new project, I have $1,000 cash, I start a new project. In that project, how much I invest? $1,000. Now, accountant will pass an entry, fixed as $1,000 to cash what? $1,000. That's all for in the matter over. Yes or no? Now, for me, cash $1,000 goes out, no problem. But I will not say fixed as is $1,000. The fixed as value is the value of the project. Everybody following or not? Yes, sir. Okay, I'll tell you 2 situations or 3 situations here. Okay, now. R greater than KE or is equal to KE or less than KE. Yeah, Walter, correct? So R greater than KE, R is equal to KE, or less than KE. Can I proceed further or not? No. See, when I invest in this project, shareholder wants some return. And the project is expected to give some other return. Right or not? What the project is expected to give, I call as what? What the shareholder wants, I call as what? KE. What they want, it may give. What they want, it may not give. Yes or no? It may give more. Or also give what? Less. Now listen carefully. In that case, what happens is, if R is greater than KE, R is what? Greater than KE. Let me have an example here. I write it here. See. Okay. Project gives a 12% return. I want a 10% return. I want how much return? 10% return. Can I proceed or not? R is 12%, this is what? 10. Okay. What happens is, here cash flow, for simple example, I call this as level perpetuity. What perpetuity? Level perpetuity. Can I proceed or not? Now, year 0, I invest how many dollars in project? I invest how many dollars here? $1,000. 1 to infinite years, the project gave me $120. Yes or no? Now, I said as an investment opportunity or not. This investment opportunity, if I invest $1,000, IPCC calculation, I expect to get 1, 2, 3, 4. We estimate cash flows for the project or not. Like that. If I invest $1,000, for simplicity, this project will give me $120 forever. It's a perpetual project. Respond. Yes or no? In that case, tell me, what is the IR of this project? The IR by how much percentage? 12%. But for calculating NPV, we have discounted IRR, cost of capital, cost of capital. What is the cost of capital? 10%. So what I do is, I have year cash flow, year 1 to infinity. What is the cash flow? 120. Discounted cash flow is equal to what? Cash flow divided by KE. Other cost of capital is what? KE. Tell me, what is the cash flow? 120. What is KE? 10%. What is the amount? $1,200. For me, the project is not worth $1,000. What how much? $1,200. Yes or no? There is $200 extra NPV. Are you following what I am saying? Now, again I say, again repeat. Let's take this Mardigilani Miller example itself. Okay, situation number 1. $1,000 cash I am having. Yes or no? Correct? I am having $1,000 cash. This $1,000 cash, I am going to invest in machinery. I am going to invest in what? Machinery. I figure the call as what? Machinery. Why invest in machinery? Because the machine is expected to give me future cash flows. Everybody, starting I am saying, are you following or not? Now, $1,000 cash has now become what? Machinery. I invest $1,000 in machinery and the machinery is going to give me some future benefits or not. Now, I say, this machinery gives you $120. Gives you what? $120 every year. For how many years? Forever. A perpetual investment. Simplicity assumption. Are you following or not? Tell me. What is the discounted cash flow? Cash flow divided by R. The IRR for this how much percent? 12%. You know the IRR is how much percent? 12%. Now, if I discounted the KE, the shareholder wants how much return? 10%. 120 rupees they are getting forever. The required rate of return is what? 10%. What the value of a bond? Tell me. Present value of the future cash flow discounted required yield. Yes or no? Like that. The yield is how much? 10% I want. So it is 120 divided by what? 10%. I feel that this asset is worth $1,200. Why the asset value is more than what I purchased? Because I wanted only 10% from that asset. The asset is giving me what? 12%. If the rate given is more than what I want, I am willing to pay more price for it. Right or not? Same as bond valuation. Right or not? There's a bond giving, say, 12% coupon. The white team is what? 10%. Everybody in the world is wanting what? 10%. Bond gives 12%. I'll pay more price for the bond, less price for the bond, more price. The bond value increases as the white team decreases. Right or not? Same way, I want 10%, but the asset is expected to give me how much percent? 12%. I'll value the asset as same $10,000, more than 1,000, more than 1,000. So I say the asset is not worth $1,000. It's worth how much? $1,200. Right or not? Yes or no? Let us see what happens in the market. What happens in the market? Every time when a company announces a project, share price in the market changes. Have you noticed or not? Now, Tata announcing a nano project, then share price what? Changes. They're going to go for a new merger, the share price what? Changes. Every time when a company announces something, information, the share price changes. Yes, why the share price changes? Question arises now. Information in newspaper one report came, why the share price what changes? Nothing has happened till today also, same employees going and what? Coming out only, nothing has tangibly what changed. Why any announcement makes the share price what change? Question arises, no? This is how it changes here. See, now we are having a balance sheet. We are having what? Balance sheet. Tell me, cash is what? Zero. The cash is being fixed assets or not? Then we have what? Fixed asset. Accountant will say that $1,000 cash has become what? $1,000 fixed asset. I will say that the $1,000 cash has become what? A fixed asset worth how much? $1,200. So my fixed asset is going to be how much? $10,200. Share by what? 1,000 share. Immediately on announcement of the new project, share price jumps to 10.2. Are you following or not? Right or not? See, $1,000 cash has become what? Fixed assets. Yes or no? Accountant says, I took $1,000 from bank and purchased machinery for what? $1,000. In your accounting balance sheet, cash becomes what? Fixed assets. That's all. We are not going to record the future benefits. Yes or no? But what I will say is, $1,000 cash vanished. $1,000 cash has what? Vanished. It has not become $1,000 fixed asset. I am using that to buy a fixed asset. What? How many dollars? 1,200. What I pay is not important. What I get only is important. Everybody, yes or no? I am not paying to anybody. The asset is only changing the form. Yes or no? Cash and machine cannot be having the same value. Cash machine cannot be having what? Same value. The accounting entry wrong because cash account credit, machine account what? Debit. $1,000 you put or not? I say cash is having a different value. Machine is having what? Different value because cash value 1 rupee value today is what? 1 rupee only. But the machine value 1 rupee not is what? 1 rupee. It all depends on the return I expect from the machine. Yes or no? In that case, I say the fixed asset is not 10,000. It becomes how much? 10,200. How do you get 10,200? It is $10,000 plus 200 NPV. Yes or no? That is why positive NPV project immediately maximizes the wealth. Yes, IPCC, no? NPV positive means what? Maximizes the wealth. Negative means what? Reduces the wealth. So when I always announce a project with what? Positive NPV, market will not wait whether they are earning or not. Let me see and pay price. Not at all. Market price is for information, not for performance. Market price is all for information. Market believes, if the market believes that the NPV is what? 200. Now, immediately they pay what? 20 paisa extra to buy the share. Yes or no? Now, sir, tomorrow, if the performance is poor, what happens now? Then they'll reduce the price. You start a new project here, the project is not clicking. After 2 years, people feel the project is what? Bad. Then what they do? They re-estimate the cash flow and reduce what? Share price. That share price drops because of a new information that the project is not performing. Are you following what I'm saying? That means share price always reacts to what? Information. Always reacts to what? Information. They factor in information. Share price factors what? All the information about the future of the company. Yes or no? Now, when the company announces a project that I am going to go for a project having $200 NPV mean, immediately what happens? The share price becomes 10.2. Becomes what? 10.2 because 0.2 is a positive NPV. Yes or no? No. You should not ask us, sir. They only announce a project. They not even started doing the Bhumi Puja. It doesn't matter. Because how we can say it is going to be $200 extra? They believe that it is going to happen. They believe that it is going to happen. If they don't believe, it will not change. That is a different issue. I am saying they believe the information. If they believe the information, the share price becomes what? 10.2. Next question. What is the guarantee that it will be giving you what the return as expected? They will wait and see what is happening. Suppose the IRR is not 12. It has dropped to what? 11% means I don't get 120. I get only what? $110. Next time, when they come to know about the new news, when I come to know about what? The new information, as the new information trickles in, what happens? The share price drops. Suppose they say it is performing exceedingly well. It is not 12% here, it is 120% IRR, better than smuggling business. In the case, what happens here? Then immediately what? The share price jumps to what? Much more higher numbers. So share price is not based on what is happening, it is always based on what is expected to happen. That should be kept in mind. Are you follow what I am saying? In the wavelength should be there to understand equity valuation in its truest sense. Otherwise, you will always feel confused. What is happening? Everybody following or not? That is why you may wonder, sir, daily about US QE tapering. Somebody said something. Why a share price should what? Change here. Is the information which affects what? A company. So share price will change. Yes or no? If the information, sir, it doesn't say ultimately doesn't affect now. Once we know it is not going to affect, what happens? Share price increases once again. Everybody following out. So always, whenever information comes, the market reacts to it, factoring in that information, and what market reacted as proved to be wrong now, it will do the correction once again. That's why they say always the market is what? Correcting itself means it has wrongly interpreted the information. Once it what? Rightly gets new information, the price is going to obviously change. That is how the share price is going to move up and down. Everybody following what I am saying? So what I want to say is $1,000 cash is now becoming how many dollars? $1,200 fixed assets. Suppose this $1,000, that is the K is how much? 10%. I expect to get only how many dollars? $100. In this case, what is the value of the machinery? $1,000. What the NPV? 0. A cash worth $1,000 has become what? Machine worth $1,000. When I invest in a project having NPV 0, that is I meet the shareholders' expectation exactly, does not exceed the expectation. Then they'll keep the share price what? Unchanged. They give the share price what? Unchanged. So if I meet their expectation, the share price will not change. If I outperform, the share price will what? Increase. Suppose I have a project only with how many dollars here? $80. In that case, the value is only how many dollars? $800 mission. A $1,000 cash, you put in what? $800 mission. The share price will not be 10. It becomes how much? 9.8. Everybody, are you following what I am saying? So the share price movement up and down depends on my investment is what MM says. What MM says here? It all depends on your investment opportunity. If you have so many investment opportunities having what? Positive NPVs, the market will what? Increase the share price irrespective of whether you declare dividend or not. Are you following that? In this case, dividend does not come into picture at all. Where dividend came into picture, I am saying share price goes to 10.2, comes to what? 9.8, purely based on what? The investment opportunity available. It does not depend on how I finance equity or debt. It does not depend on what? The dividend policy, because if the investment is having a positive NPV, I'll surely make the investment irrespective of what? Declaring dividend or non-declaring dividend, which is proved through his theory. Everybody following or not? Now tell me, value of a share as per MM is purely based on what? Investment opportunity available. Does it depend on financing? Because he has proved that irrelevance in his capital structure theory in IPCC, primary and secondary arbitrage. Does it depend on dividend? No. He has still proved that this $1,000 investment, whether I declare dividend or I don't declare dividend, still I am going to what? Make it, and the share price remains what? Unchanged. Also he proves, right or not? In that case, share price of the company does not depend on capital structure. It does not depend on what? Dividend. It purely depends on what? The investment opportunity available to the company. Respond yes or no. If there are a lot of projects in pipeline with positive NPVs, I'll go for the company. If company does not have any good investment opportunity, I'll surely what? Reduce the share price. Respond yes or no. Now, I'll ask you one question. There is no investment opportunity. Or question, there is no investment opportunity and $1,000 cash not declared as dividend. Then what happens? The share price reduce because this $1,000 is kept in bank account or not? it may fetch me maximum 4% or 5%. If I put in FD, may give me what? 8%. Shareholder may expect what? 12% or 13%. If this cash now is what $1,000 only, but the present value of the future cash from the cash may not be what? $1,000. Suppose the FD interest is only 8%. Now I want 12% means what happens here? I want 10% means what? There's a negative NPV from the cash. It becomes what? $800 cash immediately. Everybody yes or no? That is why company sitting on cash, idle cash, has a share price dropping because they now don't know what to do with the money. If you don't know what to do with the money, Walter comes. What Walter says? Give it as what? Dividend or buyback. Then Morgan and Miller is going to fail little bit. Yes or no? Morgan says it is not due to my decision here. They don't have investment opportunity. So the share price what? Drops. That is what he argues. But still, you should make a decision to declare dividend or not. The Walter becomes relevant. I don't say anybody is right. Everybody gives what? Own angle. All should be read together to make a decision in a case-to-case basis. Are you following what I am saying? So this is what we call as the market value balance sheet. In the first point I wanted to discuss. The point. So I am not wasting time. I am now giving you a background. With this background only, the remaining subject should be what? Learn. Okay. Some things, how you understand and what is really the meaning will be actually different. Only we know the true meaning of that, we'll be able to appreciate the various calculations or various interpretations to be given in the later stages. Everybody have the clarity or not? Now, let me continue to the next point. I'll just consolidate and then continue. My first question is, $10,000 equity is a share capital, reserves and surplus, neither of the two. It is what? The current market value of the share. How the share gets its value of $10,000? Share is a piece of paper, it is valueless. Share gets the value because of the asset which it represents. It represents what? The company's asset. What are the two companies' asset? Cash and then fixed asset. The value of 1 rupee cash today is what? I can distribute to shareholder, they can earn the money or not. The value of the 1 rupee cash today is what? 1 rupee. So the value of $1,000 cash today is what? $1,000. Yes or no? But the value of fixed assets is not the book value, it is what? The present value of future benefits. See, all the projects of the company calculate the present values. That becomes what? The value of the fixed asset. So this is a company which is a $10,000 company having how many shares here? 1,000 shares. So the value of every share is 10 rupees. Is the market value of the share. Point number one. Accept or not? Next. $1,000 cash suppose becomes a fixed assets. Then what is the entry I pass in accounts? Fixed assets to cash $1,000, $1,000. But we don't pass an entry because cash $1,000 goes. That's the value of the cash, I accept. But what comes in is not fixed assets of $1,000. It all depends on the NPV from the fixed assets, yes or no? So the fixed assets value is amount invested plus or minus the NPV, yes or no? The NPV is what? The future projections. Are you following what I'm saying? So immediately, if the cash becomes a good asset, the value of the company what? Increases. A $1,000 cash is going to be invested in asset worth what? 1,200. Now, don't think the company balance sheet is now 10,000. It becomes what? 10,200. Immediately, once in the newspaper, the information comes in the share market, share price what? Increases to 10.2. Yes or no? Sir, this does not happen, sir. Only word of mouth announcement made. If the announcement is retract, tomorrow they say, no, I'm not going to keep the investment. I'm going to keep what? Cash means what? It comes back to what? $10. Share price always acts to what? The current and new information. It is not going to act till what? Everything is getting over because I cannot wait for things to get over and value the share because the value of the share is not for the past benefit, only for what? Future benefit. Future is all about what? Information. Everybody following or not? So this is the next issue. If I invest or more than KE, the value of the company increases. Or less than KE, the value of the company decreases. Or is equal to KE, value of the company remains same. MM says that your company's value depends purely on what? The investment opportunity available. How you fund that investment, and number two what? How we deal with the retained earnings are only incidental matters. If I have a good project, my company value will surely what? Increase. Even if I declare dividend, is not improved in its irrelevance. Everybody, are you following or not? This is what has been discussed till now in this particular area. Can I proceed? Okay, now let me discuss one more point and then conclude. Now, or two more points. People may ask, sir, we gave the example using equity and what? Debt. What, sir, if the $10,000 company is funded by what? Equity and what? Debt. Question arises, no? Now, Again, what MM says that the company value will not change. The company value will not change. He proved it in the IPCC. VU is equal to what? VL. VU means what? Value of unlevered company is equal to what? Value of levered company. Whether I balance it, that is the asset value does not depend on liability value. Correct? Whether I get the money from borrowing, whether I get the money from what? Shareholder, the asset will give me what? Same cash flow only. What is this? The value of the asset remains what? Unchanged. Only thing is, the debt value will remain constant. It remains what? Constant. After knocking off debt, whatever left will be what? Equity shareholders value. Yes or no? So when you go for a positive NPV project, the $200 NPV will be enjoyed by debt or equity? Equity only. Yes or no? But the share price increases more than what I have now because of leverage effect. Are you following what I am saying? See, I borrow at 10%, I invest how much percent? 12%. 2% extra NPV I am going to get or not? This NPV will be given to debt provider by increasing coupon. No, I will be getting only what? Shareholder will be earning that particular, say, extra NPV. The extra NPV shareholder earns out of his own money, dependent holders money, his ROI automatically what? Increases. That is what we call as a leverage effect. It is studied in portfolio later. Everybody following what I am saying? So this is what you have to understand. Whether I finance through debt or equity, the company value will not change. He is from Morgan and Miller, proved in his what? Capital structure theory in IPCC. Are you following or not? So dividend irrelevant, capital structure irrelevant. The only relevance is what? This investment opportunity. Why the company share wealth did not change? The wealth did not change because it is having an investment opportunity giving how much NPV? Zero NPV. Hence the wealth did not change. It is having an investment opportunity giving a positive NPV. Wealth will surely what? Increase. Is the understanding. Can I proceed or not? No. The last. Sir, in this example, I did not divide it by 1 plus KE. Share price before dividend, share price what? After dividend. So, formula we had NP0 is equal to what? P1 into N plus M minus I plus E divided by 1 plus KE. Right or not? Now, in this example, I did not use what? 1 plus KE. Is this example and the problem different? I will say both are same only. That everything is happening after 1 year. Everything is happening what? Today. That's why hence discounting is not required. Very simple, yeah? Now, tell me, what is the share price before dividend? 10 rupees. What is the dividend? 1 rupee. What is share price after dividend? 9. In the last problem, share price before dividend, 112. Dividend is what? 10. What is after dividend? 102. In number, right or not? Yes or no? I discounted by 1 plus K to find out P0 because P1 is after 1 year. Here the P1 is what? In the same day. Everything is done in what? Year 0 discussion. Hence I did not discount by what? 1 plus K. Otherwise, this example and that sum is what? Same only. Except for discounting by 1 plus K. If you want, I can say this. I am discounting by 1 plus K power 0. I am discounting by 1 plus K power 0. Very simple. See. This example sum we are having or not? No. This example sum, answer my question. This number of shares 1000 is N. Number of shares 1000 is what? N. Accepted? Let us come back to Morgan and Miller problem here. Okay, everybody good morning. Now listen here. The number of shares, what is the current number of shares? 1000. Forget everything, listen carefully. What is the existing number of shares? 1000. What investment opportunity? $1,000. What is that dear? I. Correct. And what is dividend D? The D is what? $1. Dividend is what? $1. Now, listen here. I'll write here. I is equal to how many dollars? $1,000. N is equal to how many shares? 1000 shares. D is equal to D1 is equal to how much? $1. D1 after the dividend. Or you can simply call as what? D. Dividend. Okay. Now, only thing is, all these are not going to happen after 1 year. It's going to happen what? Today. In that sum, after 1 year, I am going to make what? Investment of 10 lakhs. And at the end of first year, I expect to have what? A dividend of $1. So that is how much rupees? 10 rupees and so on. All the numbers given there is what? After. What I am hearing is what? Before. That's the only change. Right or not? Now, tell me. P0 is equal to what? P1 plus D1 divided by 1 plus KE power 0. Everything is today or not? Now, in the case, what is P0? $10. The share price today is how much? $10. is equal to P1 plus D1 is what? $1 divided by 1 plus KE. Anything is going to be what? 1 only. If I arrange it, I get what? P1 is equal to $9. When dividend is declared, right or not? Dividend is not declared, what happens here? $10 is equal to P1 plus 0 divided by 1. P1 is how many dollars here? $10. So, two question answered. What is share price when no dividend declared? What is share price when dividend is declared? The answer is what? $9 and then what? $10. The only difference between last sum and this sum is, in last sum all are what? After 1 year. They ask you what is share price and a year later. Now we are going to discuss what? Today. The investment is happening today. The example timing only changes. The formula does not change. Everybody, are you following or not? Yes or no? And number of shares, we have what? Number of shares. Tell me, what is the formula for number of shares? MP1 is equal to I minus E minus ND1. Ennappa, right or not? I minus E minus ND1. Can I proceed or not? Now, in that case, M into, what is that? $9, I'll have $10. No dividend, no. M into $10. What the investment opportunity here? $1,000. What is investment opportunity? $1,000. No earnings because in the beginning of the year. No earnings because what? In the beginning of the year. So don't say where is E. I'll get E only when I just work for 1 year. Yeah. Now only business started. Any earnings? No earnings. So $10,000 minus what? 0. Yes or no? So what is M? M is equal to what? Oh sorry. I minus one thing. All I have $1,000 cash or not? I'm going to finance through what? Return earnings $1,000 cash. Last year is going to be what? Finance. So M is equal to how many shares here? 0 shares. When I use a retention, I'm going to have what? 0 shares issued. Can I proceed? In the next case, MP1 is what? M into $9 is equal to what is investment? $1,000 minus what is the dividend here? The entire thing is what is? Earnings is $1,000 minus what is dividend? $1,000. It becomes what? M is equal to $1,000 divided by 9. Is how many shares here? 111 shares. Everybody following or not? Now, again I say, very simple. I have $1,000 cash or not? Is the cash earned in the last year or not? Now I'm in the beginning of this year. The cash earned is how much? $1,000. So earnings I have $1,000 cash. I declare how much dividend? 0 dividend. So the $1,000 investment is financed through what? $1,000 cash. What the number of new shares to be issued? 0. Now in the next case, $1,000 cash is having. I declare $1,000 cash as what? Dividend. $1 into 1,000 shares. And what is the requirement? $1,000. I should have what price here? $9. How many shares here? 111 shares. Everybody yes or no? Now this example and that problem both are what? Same. Only difference in this example is all the numbers are in today's term. There the investment earnings are given in what? End of the year. That's the only change between the sum and this example. Otherwise the answer is what? Same only. Able to understand the link between the two or not? With this we have completed everything about the share valuation in context of what? Modigliani-Miller approach. Let's have a brief notes in this regard and then go to the next area called as rights issue. Okay, now write down notes. Write down notes. Yes. Write down notes. Point number 1. Point number 1. Understanding the balance sheet given in the example. Understanding the balance sheet given in the example. Point number 1. Understanding the balance sheet given in the example. Point A. The right point A. Equity of $10,000, equity of $10,000 is not, equity of $10,000 is not what? Book value. Equity of $10,000 is not book value. Bracket la, it is not as I correctly said, it is not share capital plus reserves and surplus. Equity of $10,000 is not book value. Bracket la, it is not share capital plus reserves and surplus. It is not share capital plus reserves and surplus. Bracket close. Everybody understanding it or not? Next, point B. The value of equity is derived from. The value of equity is derived from. Tell me, equity is a real asset or financial asset? Real asset or financial asset? Financial asset. It always has value only from what? Real assets. Okay. The value of equity is derived from the value of assets of the company. The value of equity is derived from the value of assets of the company. The value of equity is derived from the value of assets of the company. So I am now dictating, put your mind, apply and write. Okay. So don't think I am discussing something out of syllabus. All these are real issues to be understood while understanding the subject per se. Can I proceed? Point B or point C? Point C. In the above balance sheet, there are two assets. In the above balance sheet, there are two assets. In the above balance sheet, there are two assets. Branch it into two. Branch it into two. Name, what are two assets here? Cash, fixed assets. Cash, fixed assets. Cash, put the down I can write. The value of $1,000 cash today is, cash, put the down here I can write. The value of $1,000 cash today is, the value of $1,000 cash today is, how many dollars? $1,000. The value of $1,000 cash today is $1,000. What is the value of 1 rupee today? 1 rupee. Because cash is cash only. It does not have any future benefit. No, value of $1,000 cash today is $1,000. Go to the second brand, fixed assets. Value of the fixed assets, value of the fixed assets is nothing but, value of fixed assets is nothing but the present value of, value of fixed assets is nothing but the present value of its future benefits. Value of fixed assets is nothing but its present value of future benefits. Is nothing but the present value of its future benefits. Discounted at required return. Discounted at required return. Stop writing and tell me who is giving money. Equity. In this question, who is giving money? Equity. What is required return? KE. What is required return of debt here? KD. We got a cost of debt or YTM. Respond. Yes or no? Discounted at required return. In bracket write KE. Discount required return KE. Same branch, right? Hence, the $9,000 is not. Hence, the $9,000 is not. The $9,000 is not what? Book value of fixed assets. Hence, the $9,000 is not book value of fixed assets. The $9,000 is not book value of fixed asset, but is the fair value of fixed assets. The $9,000 is not book value of fixed asset, but is the fair value of fixed assets. But is the fair value of fixed assets. The word fair value means what? Present value of the future benefit. Is the fair value of fixed assets. Can I proceed or not? Next. Point number, point B, C or D? D. Point D. When we invest $1,000 in new project, when we invest $1,000 cash in new project, when we invest $1,000 cash in new project, the accounting entry is the accounting entry is, when you invest $1,000 cash in new project, the accounting entry is, can you tell me the accounting entry? Fixed assets $1,000 to cash $1,000. The accounting entry is fixed asset $1,000 to cash $1,000. We understand that $1,000 cash becomes, $1,000 cash becomes $1,000 fixed assets. We understand $1,000 cash to become $1,000 fixed assets. Point C or D? Point E. Really, the value of fixed assets, is not how much we invest. Really, the value of fixed assets is not how much we invest. I may invest $1,000, that may not be the value of the asset. No, the value of fixed asset is not how much we invest, but it is how much benefit we get out of it. The value of fixed asset is not how much we invest, but how much benefit we get out of it. Everybody understanding or not? Now, there can be, continue writing, there can be three scenarios. There can be three scenarios. Branch it into three. First branch, R greater than KE. Please tell me what is KE, what I want. What is R, what I expect to get from the asset. Okay, what I expect to get is more than what I want, R greater than KE. Second case, R is equal to KE. Third case, R less than KE. R greater than KE, R is equal to KE, and R less than KE. Are you following not? Now, R greater than KE, put a down I can write. The asset will give a positive NPV. Second branch, the NPV is 0. Because what I want, the asset has here. Nothing extra, the NPV is 0. Third branch what? NPV is negative. Point C or D or E or F? Point F. Don't know, another 2 points only will complete, okay? Don't worry, point F. For example, KE is equal to 10%. KE is equal to 10%. I want how much return on investment? 10%. Write two columns, year cash flow. K is equal to 10%, write year cash flow. Year 0, how much I invest? $1,000. Year 0, I invest in asset $1,000. 1 to infinity, asset gives me $120. 1 to infinity, asset gives me $120. That gives me $120. Right. The IRR of this investment is 12%. The IRR of this investment is 12%. Bracket R is equal to 12%. The IRR of this investment is 12%. Full stop. We require 10%. But the project is expected to give 12%. We require 10%, but the project is expected to give 12%. Hence, there is a positive NPV. Hence, there's a positive NPV. Can I proceed or not? Write down. The value of the asset is, same point you continue, value of the asset is, tell me all the value of the asset, present value of the future cash flow or not. So the value of the asset is DCF is equal to formula cash flow by KE. Now here the required return is KE, na? DCF is equal to cash flow by KE, which is equal to 120 divided by 10%. 120 divided by 10%. What is the value? 1,200. The value of asset is $1,200. Hence, we convert $1,000 cash into $1,000 cash into what? $1,200 fixed assets. Hence, we convert $1,000 cash into $1,200 fixed assets, increasing the company's wealth. We convert $1,000 fixed assets into cash into $1,200 fixed assets, increasing company's wealth and shareholders' wealth. Increasing company's wealth and shareholders' wealth. I think you understand the sense of the dictation now. Same point you continue. Or next point if you want. Point E, I, F, or G, M? G, point G. Later if we find that the asset return is less. Later if we find that the asset return is less. What happens to share price? The share price drops. Later, if we find that the asset return is less, the share price drops. Thus, share price represents information about the company's future. The share price represents information about the company's future and always reacts to new information, good or bad. And always reacts to new information, good or bad. And always reacts to new information, good or bad. Okay. I'll ask you a question and then we can conclude now. Tell me, Axis Bank share, is there na? Good share or not? Do you understand my question or not? TCS share is that in IT sector, good share or not? Yes. Let's take two companies, TCS, Infosys, which is good share? TCS or Infosys? Currently, TCS is what a good share. Even though Infosys might have been number one in past, now who is number one? Everybody, are you follow what I am saying? Now, in that case, past track record shows Infosys as great, yes or no? But the future shows what? TCS as great. The reason is Infosys, key persons are all what? Resigning. The business is not what? Picking up. Are you following not? Now, the share market does not look at past. So great, Narayan Murthy was there. Okay. So, let us give more price to share. They don't say like that. They say, today who is great here? Or tomorrow who they believe to be great? TCS. So, the share price does not depend on past. Depends on what? The future. Tell me, Kingfisher Airlines was number one in past. It or not? Yes or no? Now, is the share price very high? No. Because once you know that something is bad happening about the company, we don't see the past track record and I'll pay the price for share. We always see only what? Future. What you have done in past is past. I don't pay price for that. I pay only price for what? What is going to happen in future. Again I say, share price is not for the past. Share price is for what? The future. People say, see, company with what? Good track record and all. It is only to believe in future, that's all. But good track record company, if we don't have a belief in the future of that company, I still not pay what? Any price. A company with a bad track record, but very promising future, I still pay what? More price. So price is for past info or future info? Future info is what I wanted to convey here. Everybody following or not? Now, point number one over. What is point number one? Understanding what? Balance sheet. Now, point number two, small point. Point number two. If the new project is financed through debt, if the new project is financed through debt. Remember, question of debt is zero, na? If the new project is financed through debt, will the wealth change? If the new project is financed through debt, will the wealth change? Question mark. Answer yes or no? As per MM, it is no. Other people say yes, okay. As per MM, it is no. As per MM, it is no. Which he has proved in capital structure theories. As per MM, it is no. Which he has proved in capital structure theories. Which he has proved in capital structure theories using primary and secondary arbitrage. Which he has proved in his capital structure theories using primary and secondary arbitrage. Using primary and secondary arbitrage. You remember, well and good. Otherwise, think that the debt will not what? Change. It is already proved. Right or not? Next, point number 3. Point number 3. The example and question number 9. The example and question number 9 are same. Correct? Huh? Don't say number and change here. I am saying concept. Example and question number 9 are same. Except that in question 9, the investment, the earnings and dividend. Except that in question 9, the investment, the earnings and the dividend are going to happen. The investment, the earnings and dividend are going to happen what? A year later. Are going to happen a year later. In this example, it is today. In this example, it is today. In this example, it is today. Simply replace, continue, simply replace 1 plus ke power 1 by, what you should do? Simply replace what? 1 plus ke power 1 by what? 1 plus ke power 0. The denominator becomes 1, that's all. Simply replace 1 plus ke power 1 by 1 plus ke power 0. So tell me what is NP0? NP0 is equal to what? P1 into n plus n minus I plus E divided by what? 1 plus k power 0 in this case. That's all. Simply replace what? 1 plus k power 1 by 1 plus k power 0. So with this we have completed this slot called as what? Modigliani-Miller approach. Core dividend policy chapter completed here. We discussed about Walter, Gordon and then what? Modigliani-Miller approach. I have some more problems and issues discussed, very interesting. In our workbook, we completed 50% of the chapter. How much percentage? 50% of the chapter. Still another 50% remains. What remains, I'll tell you. We have buyback, we have rights issue, we have residual dividend policy and Lintus model. We have one case study type of problem. It is an RTP question only, very interesting sum. And we have 2 small problems left out in what? Walter and Gödel is what you have to get completed in this chapter. Can I proceed to the next stage or not? No. Okay. What I can do is, I'll quickly do the 2 sums in the workbook. Both are examination sums, Walter and Gödel, to complete it and then go for the rights issue introduction today. We'll complete the rights issue and others in the next class. Okay. Now please take question number 2. Okay. Now, I have spoken so many things, I don't know how much I have assimilated. My duty is to tell, your duty is to what? Focus and listen. I hope you have understood it, but forget about last 1 hour discussion. I want 3 things. Share valuation formula in this chapter, 3 formulas. P0 is equal to what, Walter? D plus R by KE into E minus D divided by KE. What is Gödel? E into 1 minus B divided by KE minus BR. What is Modigliani-Miller? E into 1 minus B divided by KE minus BR. That's why I said no. What is Modigliani-Miller approach? NP0 is equal to P1 into N plus M minus I plus E divided by 1 plus K. Apart from that, 2 more formulas you know. DGM. What is DGM formula? D1 by K minus C. Understand the formula? What is single holding period formula? P0 is equal to P1 plus D1 divided by 1 plus K. All are valuing what? Shares only. How you can reach God through different religions? You can use value shares through what? Different models. That's all. Only difference. Shall I proceed or not? Now, let us quickly complete the two sums and then go for the rights issue. Okay, please. Please. And one more thing, whatever we are discussing is now becoming very, very important for understanding even income tax case laws. Income tax cases, because earlier and all, the courts were not so shrewd, okay? They always decide cases not on real value judgments. That's what I am saying now. Debt securitization, so many have taught you one case or not. In that case, the securitization value had to only use what? This NPV method for valuation. Rights issue and judgment was there, where how we value the right, same way the judgment also what? Valued it and put the tax on it. Are you following what I am saying? Now, they are not putting tax generally on book value. They started seeing what? Real values of asset and start putting the tax. I think latest also one judgment came that for a merger negotiation, I think a case came 2 or 3 days back where they said you should not take the market price as it is. Market price should not be what? Believed. You should value on your own independently, because market price can be rigged during what? The negotiation stage. All judgments are what? Coming. In that case, these issues what I am discussing, only 100 marks, let me what? Escape. I am not going to look at FM once again in my lifetime. Don't think like that. To understand judgments also, all these concepts are being applied. Even accounting balance sheet, swap valuation, we don't have a book value for swap now. We have to only find out what? Valuation using the finance principle. This is going to be applied everywhere. They are discussing basics. Those are all advanced, where they will be applying that in the accounting as well as the taxation angle. Now, I am saying this all to motivate you to learn here. Correct? No, okay, not our subject. Okay, like that, don't think. And don't think I am telling lies. I don't tell lies here. I am motivating by telling the truth only. Yes or no? It is what? The truth also. So always to motivate, he says something and then what? Let me not get motivated. Don't think like that. This is bread and butter of our profession also. Are you following? Now, next. Take question number 2. Please. Don't talk. From the following information. Either you sleep or talk or eat. Class listening. I am seeing people are eating in the class. Yeah. Please. Don't eat. I will feel hungry. I am not standing here. No. Shall I proceed? No. From the following information, please. From the following information supplied to you, determine the theoretical market value of equity shares of a company as per Walter's model. No new concept, but one small issue will be discussed incidentally. That's all. Okay. Earnings of the company 5 lakhs. Dividend paid 3 lakhs. Number of shares outstanding 1 lakh. Price earning ratio 8. Price earning ratio is what? P ratio. You all know the formula for P ratio? No, what is P ratio formula? MPS divided by EPS. It is 8 rupees. Rate of return investment is 15%. What is 15%? R. That is the rate of return on retained earnings, 15%. Are you satisfied with the current dividend policy of the firm? If not, what should be the optimal payout ratio? In this case, it's an examination problem for 6 marks. Okay, very simple sum, but the test the concept of Walter here. Okay, now. Before I proceed, a small discussion about PE and then I go for the problem. Okay. PE is a great issue I'll discuss more elaborately about PE during equity valuation chapter. I have trailing PE, leading PE, etc. I'll discuss at that time. Here I just want to only give you working knowledge about PE, that is enough. We don't want to digress too much away from the dividend policy. Can I start or not? Now, see, what is the value of a share? Every time I have to confirm what the value of the share. Present value and the future benefits from the share. Okay. Always don't use the word cash flows. Use the word what? Benefits. That's a much more better way of presenting. Present value of the future benefits from the share is going to be what? The value of the share. Response is or no? No. See. I purchase a share. It is going to give me for 1 to infinite years EPS. It's going to give me for 1 to infinite years EPS. What is the value of the share? Discounted cash flow is equal to what? EPS. The cash flow is what? EPS divided by what? KE. Response is or no. There are so many valuation model, constant dividend model, constant earnings approach, dividend growth model and so on. This is called as what approach? Constant earnings approach. So the value of the share is what? EPS divided by KE. To understand simply, I can say like this. I earn every year 10 rupees. I earn every year how much rupees here? 10 rupees. Suppose the entire 10 is given as what? Dividend. What the growth? What the growth here? 0. So I am going to earn every year what? 10 rupees forever. Right or not? Now, see, constant earnings approach here. I earn 10 rupees EPS. What is EPS? 10 rupees. Retention is 0%. 100% what? Payout. What is dividend? So EPS is equal to what? Dividend. I can say this EPS as dividend cash flow. No, right or not? So in that case, the dividend also is how much rupees here? 10 rupees. The dividend in first year 10 rupees. Second year how much dividend? 10 rupees only. Dividend will not grow because there is no B to give me growth. Right or not? Correct? That means it becomes a constant dividend model. So no, the constant dividend is constant earnings also because I don't grow. The entire earnings is given as what? Dividend. Accepted? In the case, the value of the share is EPS by KE. This formula, everybody accepting it or not? Now, very simple. P0, the value of the share today is what? EPS divided by KE. Right or not? Now, that means what is KE? EPS divided by P0. P0 we can also call as MPS, the price of the share today. So KE is equal to what? EPS divided by MPS. He is going to give me the KE formula. Response is or no? Now, KE is equal to EPS by MPS. Now, we know price earnings ratio. What ratio? Price earning ratio. Very simple. Price divided by earnings. Equal as what? Price earnings ratio. What the formula? MPS divided by EPS. From this we know that KE is EPS by MPS. P ratio is what? MPS by EPS. So what is P ratio? 1 by KE. What is KE? 1 by P ratio. That's all if you learn. That is enough. What P ratio represents? How many types of P's are there? All this I'm discussing in what? Equity valuation. Just a small intro to what? P ratio. That's all. Everybody following or not? Now tell me. I am going to get infinite years EPS. What is the value of the share? Present value of the infinite years earnings. No, it's not no. What is the present value of the infinite years EPS? EPS divided by discount rate. What is discount rate required? KE. EPS by KE gives you the value of the share today. It's not no. The share price today is EPS by KE. But what is KE? EPS divided by share price. Share price by EPS is P ratio. EPS by share price is what? KE. So 1 by KE is equal to P ratio. 1 by P ratio is equal to what? KE. That limited discussion I want to make regarding P ratio at this stage. Everybody following or not? Now, based on this, let us complete this examination problem. Can we start or not? Now. Let us do it together. Write on question number 2. Question number 2. They ask you to value the share using what model? Walters model. Let's start with the discussion first. Walters model, underline that. By the formula, P0 is equal to, always write the formula and substitute. P0 is equal to D plus R by KE into, P0 is equal to D plus R by KE into E minus D divided by KE. P0 is equal to D plus R by KE into E minus D divided by KE. Can I start or not? Now. E is equal to, E means earnings per share or not? E is equal to, what is the earnings? 5 lakhs. How many shares are there? 1 lakh shares. Look at the workbook and write 5 lakhs divided by 1 lakh. What is EPS? 5. The EPS is 5. Can I proceed? Next. D is equal to, D means dividend per share. D is equal to, how much dividend? 3 lakhs divided by 1 lakh. 3 lakhs divided by 1 lakh. D is equal to how much rupees? 3 rupees. D is equal to 3 rupees. Right or not? Next. KE is 1 by PE ratio. Now only explain. Right or not? KE is equal to 1 by PE ratio. Now PE ratio is MPS by EPS. KE can also be written as EPS by MPS. KE is equal to 1 by PE ratio is equal to 1 by 8. Is equal to 1 by 8. Is equal to how much percentage? 12.5 percentage. K is equal to 12.5 percentage. Can I proceed or not? Now, R is given as how much percentage? 15%. R is equal to 15%. R is equal to 15%. First, don't value. Tell me the conclusion. They can earn how much percent from the retention? 15%. How much shareholder expects? Should I give them their money or keep their money? Why should I keep their money? Because I will be able to earn more than what they can. Are you following what I am saying? So as per the Walter, they should give how much dividend? 0 dividend. They should retain what? 100%. Are they retaining 100%? No. They are giving what? 3 rupees. 60% is what? Dividend. That is not the optimum payout. Yes or no? Now what we should do is, we should say this is not the optimum payout after finding out the share price. Can I proceed or not? Write down the share price. P0 is equal to, P0 is equal to 3 plus D plus, D is 3 na? 3 plus 0.15 by 0.125, 3 plus 0.15 divided by 0.125 into 5 minus 3, 3 plus 0.15 by 0.125 into 5 minus 3 whole divided by 0.125. 3 plus 0.15 by 0.125 into 5 minus 3 whole divided by 0.125. If I simplify, I will be getting how much of base? 43.2. As per the Walter, a company following 60% payout. Got about? Yeah, right? How 60% payout? Out of 5 rupees, 3 rupees given as what? Dividend. Company following 60% payout will have its share trading at 43.2 rupees. Now tell me, is this payout right or not? No. Write down. Company is not following optimal dividend policy. Company is not following optimal dividend policy. Company is not following optimal dividend policy. When R greater than KE, when R greater than KE, optimum payout should be 0%. When R greater than KE, optimum payout should be 0%. Optimum payout should be 0%. At this payout, share price will be 48 rupees. At this payout, share price will be 48 rupees. At this payout, share price will be 48 rupees. Tell me how it will be 48 rupees. We should calculate now. Okay, write the number. P0 is equal to, P0 is equal to, you asked us, where 48 should I ask or not? P0 is equal to, what is dividend? 0 plus. I retain fully na 0 plus 0.15 by 0.125, 0 plus 0.15 by 0.125 into 5 minus 0 divided by 0.125. 0 plus 0.15 by 0.125 into 5 minus 0 divided by 0.125 is equal to 48. Is equal to 48. Had they retained fully, the wealth would have been how much rupees? 48. By having a wrong payout policy, the wealth is what? Even though they had a good investment opportunity, the share price is still what? Less. Because they have a bad payout policy. This is not accepted by Mardigal and Miller. Yes or no? Mardigal Miller says that whether we pay out 60% or what? 100%. My share price remains what? Unchanged. He is his proof. Yes or no? But your Walter says your dividend policy too affects what? The valuation as well as the wealth of the shareholder. Everybody following or not? Now, take question number 3. Take question number 3. Examination sum once again. this sum, I will do how it is done by suggested answers, and then we can have our own way of doing the solution. Okay, take question number 3. The following figures are collected from annual report of XYZ Limited. Please. Particulars. Net profit 30 lakhs. 12% preference shares of rupees 100 lakhs. Number of equity shares 3 lakh shares. All the numbers are given in what? Lakhs. Given in the heading. Na? Expected return on investment is 20%. Tell me what is this 20%? If I retain invest, I get how much percent? 20%. What should be the appropriate dividend payout ratio so as to keep the share price at how much rupees? 42. They given the share price, ask you to find out the payout ratio. P0 given, ask you to find out what? D in this problem. A reverse working problem. Respond. Are you all following or not? Can I proceed? Now, let's do the solution together. Question number 3. Shall I start above? Now, first. Calculation of EPS. Step 1. Calculation of EPS. Okay. Net profit. You can even give the name PAT. Profit after tax is called as what? Net income or net profit. Net profit. Look at the question. Tell me how much net profit? 30 lakhs. Net profit 30 lakhs. Is the entire PAT going to equity shareholders? No. All I have to pay what? Preference dividend. Minus preference dividend. Minus preference dividend. I apply how much percent? 12% coupon on 100 lakhs. What is the money? 12 lakhs. Minus preference dividend 12 lakhs. The balance is called as earnings for equity shareholders. Even called as EE. Earnings to equity. What is earnings for equity shareholders? 18 lakhs. Earnings for equity shareholders 18 lakhs. Number of shares. How many shares are there? 3 lakhs. Number of equity shares 3 lakhs. EPS. What is the earnings per share? 6. Earnings per share is 6. EPS is 6. Can I proceed or not? Now we know the EPS. Next, we have to calculate KE. We have to calculate what? KE. What is Walter's formula? D plus R by KE into E minus E divided by KE. Now my question is, in this problem, is KE given or not given? R is given as how much percent? 20%. E is given as how much rupees? 6 rupees we found out. D only we should calculate. P0 given. Enna right or not? Yeah, P0, see this formula. In this formula, P0 given yes. What is the price of the share today? 42. R we know or not? Say, we know R or not? Yes. What is R? 20%. We know E or not? Yes. What is E? 6 rupees. E pays how much rupees here? 6 rupees. And D we should find out. We should find out what? D. But we should have KE. We have KE or not? Now, I'll just suggest that assumed KE is 16%. Assumed KE is what? 16%. They assumed that did that sum. I don't know how they can make assumption. Then if I don't know a question, I can assume one question which I know and do the answer also, right or not? Now the KE has been assumed and what done. I am doing as done by the suggested answer. We can also see an alternative way of doing the problem later. Can I proceed? Now, write down. D is equal to X. Continue. D is equal to X. I have to find out unknown figure. R is equal to 0.20, 20%. R is equal to 20%. KE not given in the question, hence what? Assumed. KE not given in the question, hence assumed. Don't ask me why, yeah, that's the answer. I am just doing what is given, 0.16. KE not given in the question, hence assume 0.16. If I write the exam, I don't know how to assume, because assumption can be there in concept and not in question. I cannot assume a question and write the answer, but that is what is given in the examination. Okay, now. P is equal to 42. The P0 can also call price is equal to 42. Now, can I proceed? Substitute. 42 is equal to, please, 42 is equal to X plus D plus 0.120 by 0.16 R by KE into 6 minus X R by KE into 6 minus X divided by 0.16. 6 minus X divided by 0.16 is equal to 42. Rearrange. Solving it, the dividend is rupees 3.12. I think I can do it on your own or not. So if you solve for X, I will get dividend as 3.12. The dividend is 3.12 and the payout is 52%. Dividend is 3.12 and the payout is 52%. How I got it? Out of 6 rupees, I give how much dividend? 3.12. Hence I pay 52% out as dividend. The payout is 52%. The payout is 52%. Am I right or not? No. Whether what I do is suboptimal or not, but in exam, I cannot assume any number and do it. I cannot assume any number and do it because I don't know that I should make an assumption. I believe the question is always what? Complete. In the given scenario, what I would have done is, we know the EPS as how much rupees? 6 rupees. We know the MPS how much rupees? 42. So P ratio is what? MPS by EPS. 1 by P ratio is what? KE. Like that I could have calculated what? KE and did the sum. Everybody, are you following? Now, we know the share price, we know the EPS. I can assume that MPS by EPS is P ratio and find out KE. That KE can be used to find out what? The dividend. Everybody understanding what I am saying? Now, can I proceed further? Write down alternatively. EPS is equal to 6. Alternatively, EPS is equal to 6. MPS is equal to 42. EPS is equal to 6. MPS is equal to 42. PE ratio is equal to MPS divided by EPS. Price earnings ratio na price divided by earnings. MPS divided by EPS. 42 divided by 6. How many times? 7 times. P ratio is equal to 7 times. KE is 1 by PE ratio. KE 1 by PE ratio 14.29 percentage. KE 1 by PE ratio 1 by 7. If you put 0.1429 you get right or not? That we call as 14.29 percentage. Walter's model 42. Not finished writing. Okay. P ratio 7 times over or not. K is 1 by P ratio 14.29%. Can I proceed? Now, Walter's model 42 is equal to X plus 42 is equal to X plus 0.2 divided by 0.1429 X plus 0.2 divided by 0.1429 into 6 minus X D plus R by KE into E minus D whole divided by 0.1429 whole divided by 0.1429. The answer should be obviously the EPS. What is the dividend here? Solving it. I will finish copying this or not? Solving it. The dividend is rupees 6. Solving it. The dividend is rupees 6. And payout is 100%. Solving it. The dividend is rupees 6. And the payout is 100%. The dividend is rupees 6. And the payout is 100%. Payout is 100%. With this, we have completed question number 1, 2, 3, 4, 5. Also question number 9. And one extra sum we did in the Modigliani-Miller approach. The next area we have discussed is what? Rights issue. 2 sums are there. Both are good problem, institute problem. One examination, another is an RTP question. Give the heading, rights issue. Don't shout here. I have a right to take up to 9:15 and now give the heading rights issue. regarding rights issue. Okay, please. Known to you, but just let us formally have a understanding and then go for the numbers. Okay. See, companies always require capital for expansion, right or not? Originally, company might issue some equity share capital, started its business, the business may be progressing, but understand that every time with retention alone, one cannot finance business. Okay, suppose MTG Gap was started long back, it was running business, it was expanding out of its profits. But company cannot hope to expand throughout only using what? Profits. If it wants to grow more, faster, it requires what? More capital base. Now, right or not? In that case, companies can go for issues of new shares and raise the money. Yes or no? This company went for an IPO to get more money for what? More investments. Everybody following not? So, investment only through retention is generally not fully feasible. You want to grow what? Faster. Sometimes the business may be bigger than me, so I should make myself bigger. Are you following what I am saying? In that case, the equity has to expand for every company, right or not? What Companies Act says that if you want to raise fresh capital, if you want to raise what? Fresh capital, first ask the existing shareholders. Are you following not? Only when they say, no, I cannot, then you can go for what? Outsiders. Right or not? That is a financial logic for that. That is what I want to discuss in this rights issue. Are you following not? Why a right should be given to what? Shareholder. For new capital, for your capital dividend giving, take and go. Yes or no? But new money, why should I ask you first? Question arises, no. Why there should be a right given to what? The shareholders for a rights issue, a parental right. Why should be what given? Is a basic logic. We will be discussing in the first problem. Yes or no? In the second problem, how the rights issue will be influenced when I take up a positive NPV project. Are you following not? So, two very good sums in rights issue. One is a basic sum, examination sum, and is a sum with a positive NPV. What happens is an RTP sum. Both will be discussing in depth in this concept called as rights issue. Everybody following or not? Now, see, company wants new capital. Wants what? New capital. Can you go for a public issue? No. First of all, you should ask the existing shareholders, can you take up the new capital? Okay, they can say, yes, I will take up. Means you will offer the capital to what? Existing shareholders. But all the shareholders may not be able to invest. Suppose there are 1 lakh shareholders in the company, majority pass a resolution that we can just raise a capital on our own. No need to go for a public issue. No need to give it to what? Third party. That means the company is going to go for the new issue or not. The new issues will be made to all of you, the old shareholders, right or not? Just because I offer you the share, it does not mean that you should compulsorily subscribe for the share, right or not? What you can do, you can either subscribe to the company's new shares or you have a right with you or not. That right, you can give it to your friend saying that I am not having money to subscribe. Let I give the right to what? My friend. Because once the right is given to me, I can deal with it in whatever way I want. Are you follow what I am saying? In that case, I can give the right to what? My friend, and he can subscribe. Yes or no? When I give the right to my friend, I am giving him something or not? When I give him something, I should charge what? A price. Yes, I should charge what? Price. I will not charge a price for the share. I will charge what? Price for the right. How to value the right is a discussion to be made in this sum. Are you following or not? Now, so again I repeat, company requires what? Share capital. I cannot go for IPO directly. I will first make an offer to what? Existing shareholders. I ask them in the shareholders meeting, can I go for IPO or can I go for what? The rights issue, the existing shareholders. Respond yes or no. If I want to go for IPO, they should pass a resolution, 81 1-year resolution as per the current Companies Act to give permission for going for what? IPO. If not, they'll say, no, we will take up what? New capital. The existing shareholders, when they agree to take up the new capital, it is called as rights issue. Are you following or not? When the rights issue takes place, every shareholder may not be having the ability to what? Buy the company share. They may want, they may not want. In that case, I give you the right to purchase the company share. That right you can exercise and purchase my share, or the right can be given to what? Some other person who can use it to what? Buy the company share. Respond yes or no. In that case, if I give the right to some other person, I have to charge some money for the right given or not. What is the value of that right is the discussion that is going to be made in this area called as what? Rights issue. Everybody following or not? Above that, we will be discussing through question number 1. Okay, I'll read the question, explain the facts. Up to a stage I'll do and leave it. Can I proceed? Now, read it, please. For 2 minutes here. Don't worry. Okay. So, all this you keep in mind. We'll have some other day what? Extra. That okay. I also cannot go up to a stage in the sum. We'll leave now. We'll continue in the next class. Okay. Please. This time, you should compensate somewhere, probably on Sundays. Okay.